In current video, I'm going to use a very simple example to show you the meaning of deferred tax assets and deferred tax liabilities, which are useful terms to investigate or to understand the financial statement. Before I show you the example, you should know what's the meaning of permanent difference and temporary difference. And in this class, actually, we do not consider any permanent difference. Actually, US GAAP require companies to exclude the permanent difference when they calculate income before tax. Okay, so what's a permanent difference? You can find the notes in the learning module of chapter 2. Actually, it's some kind of revenue or expenses recognized in one report but not the other. Okay, for example, the interest income from municipal bond. So this is the actual income will be reported or recognized in the financial reporting. But because the IRS does not tax on this kind of income, so this interest income will not appear as part of revenue in the tax reporting. Okay, and this difference is permanent because that's a regulation. The other difference is a temporary difference. That's a timing difference. The temporary difference, they probably two reporting, financial reporting and tax reporting, they are different for a certain year, right? But for a very long term, the income tax expense must be equal to the tax owed. In other words, the tax expense you paid to the IRS as cash flow should equal the tax expense you incurred in the financial reporting. Okay, temporarily, it's different year by year because we report every year for both financial or tax purpose. Right. Okay, so next, let me use this spreadsheet to show you, what's the deferred tax assets and what's deferred tax liabilities. Okay, and this is a section, okay, I'm going to talk about first. And this is tax reporting. And this is financial reporting. And this is a balance sheet. Assets equals liabilities and equity. Okay, so first I assume $100 revenue for both tax reporting and financial reporting. The difference is deductions and expenses. So in this year, 50 deduct from tax revenue and 80 deduct from GAAP revenue. Okay, so taxable income is different from income before tax. The difference is 30. And I assume the tax rate is 30%. So the tax owed is 15. And tax expense is $6. Okay, both are product of tax rate and these two items. Now we find the difference. $15. The company is going to pay $15 to IRS as a tax. So this is a real cash outflow. This will have a $15 decrease in assets, actually cash. Right? And the other one, 6, tax expense. It is expense, so it decreases stockholders' equity. So -6. So where's the difference? $9. Actually, because the company paid $15 rather than $6. So the company pay more than it incurs. Okay, so the $9 is deferred tax assets. Why it is assets? Think about it. You incur $6 expense, but you pay 15, right? So you pay more, you incur. You just like you deposit $9 in the IRS, right? So the $9 is still your assets, like prepayment tax. Right? So $9 deferred tax assets. Okay, so this is a case. The revenue was the same. The difference between deduction and expenses. So next is deductions and the expense are same. The difference in revenues. In this case, financial reporting recognize $150 revenue. Or tax reporting 100. So the 50 difference, finally, we get the difference between tax owed and tax expense. Same thing. $15 is cash outflow, so it is credit assets. So assets decrease $15, and $30 tax expense. Right? So it will decrease the equity 30. So what's the difference? What's their difference? $15 go. Right? So in this case, the company incurs $30 but only pay 15. So it actually owes the government $15. So this is like a liability, right? So it is recognized as 15 deferred tax liabilities. So liability increase 15. So the accounting, the equation is still balanced. So this is the two scenarios when company recognize either deferred tax assets or deferred tax liabilities. And actually, if we flipped the situation of two reportings, like financial reporting is here and tax reporting is here, all the numbers I just copied from this part, what I got. Okay, so the $15 is the tax expense, decreased equity $15. Tax reporting $6, so pay $6 cash. So the difference $9 is liability. Why? Because you incurred 15 but only pay 6, so there's $9 more to be payable in the future. So it is deferred tax liability to IRS. Same thing, you incur 15 but you pay 30, so pay more than you incurred. So it's $15 deferred tax assets. Okay, and here we use very simple example to introduce what's the meaning of deferred tax assets and deferred tax liabilities. And we know in reality, revenues, there are lots of items in the revenues and lots of items in expenses, right? So there are more differences. And actually, both deferred tax assets and deferred tax liabilities, they are from the temporary difference between revenues and the deduction expenses.